In today's video, we're going to talk about the difference between a CPA, Certified Public Accountant, and a controller. A lot of times when I'm talking to entrepreneurs and we're working on setting up their business, or they've been in business for a little bit and they're starting to scale, they go, I need a CPA. And while they probably do, that CPA is probably more suited for their external accounting, so their compilations and reviews and their taxes. What they're really talking about is they need a controller. So what's the difference? Well, I'm going to talk a little bit about that here because as your business scales, it's important for you to know which is the right accounting professional for me. So the Certified Public Accountant is kind of the top level certification for accountants. It's a set of career paths that is really designed to allow that person to understand those rules and laws and guidelines around accounting. They're experts in generally accepted accounting principles. They're experts in tax rules, sometimes one or the other, sometimes both. And they know how to interpret them, and then they can provide guidance. And in many cases, if you're a CPA and you're licensed, you can provide an attestation or almost a guarantee that based upon what you've reviewed, that the financial statements are fairly presented. Or you can represent the taxpayer in front of the IRS and explain to the IRS what the issues are, because you're deemed to have enough knowledge to be able to interpret the rules, know that they were applied correctly, and explain them to an outside party. So what does it take to become a CPA or Certified Public Accountant? Well, it is one of the milestones in an accountant's career, and a lot of accountants never become CPAs. That you could be an accountant and not be a CPA. And so there's a CPA is someone who has done a few things. One, they've gone through college, they've got an accounting major, or they've got enough accounting course credits to be able to qualify for the equivalency of an accounting major. So, in my case, I was not an accounting major. I actually was a finance and business economics major as an undergrad, but then took additional accounting courses both during my undergraduate period at Notre Dame, as well as once I got out. I took additional accounting courses so that I could have the required coursework necessary to be able to sit for the CPA exam. The CPA exam is a national exam that is the same in all 50 states. Now, the requirements to become a CPA vary from state to state, but the exam that folks take is a unified exam, and it's the same from state to state, and it's got multiple parts: audit and financial statements and analytics. And so you've got a multi-part exam that you take over a period of a couple days. It's standardized test and standardized scored, and then depending on your state and your cutoff, you either pass or don't pass that exam, and you have to pass 3 of 4 sections in order to be able to kind of carry forward and only take that last section. But you need to be able to pass all 4 sections with a certain grade in order to be able to move into kind of the path for qualification for a CPA. The other thing that a CPA needs is qualified experience working for another CPA. And so there's an apprenticeship component. So you basically apprentice with another CPA and learn on the hands-on training on how to become an accountant and what to look for. And then you've got this testing piece. Normally that hands-on component, which again varies from state to state, is from 1 to 4 years. And a lot of times that's fulfilled in a certified public accountancy, working for a CPA in a public accounting firm. And a public accounting firm are the ones that you see, Jim Jones, John Smith and Associates CPAs, and they're the folks that you'll pick up the phone and call to do your taxes, or to deal with your IRS audit, or to, if the bank says, hey, we need audited financial statements or compiled or reviewed financial statements, they're the ones you pick up the phone and call, and they will assist you with that process. Or they're a professional services firm, and that's what they do for a living. And normally your CPAs will go work for those folks, and that's where their apprentice time is done. Other CPAs, to get that qualified time, will work in an internal audit function at a company, or they'll work in a corporate accounting or finance function working for a CPA, doing the type of things that CPAs need to do. So reviewing financial statements, working with external auditors, etc. So you can work in public accountancy, or you can work in a company, but you have to work for a CPA and you have to do certain things during that 1 to 4 year period in order to get the qualifying experience. Once you get the qualifying experience, plus you've got the right undergraduate education, and in some cases it takes 150 credit hours, 150 credit hours to be able to get that experience or that undergraduate education, plus you've passed the exam, then you can apply to your state Board of Accountancy to be qualified as a certified public accountant. They'll review everything, and then you get your certified public accountant license, and you have to take continuing education as long as you keep your license active, depending on the state, from 20 to 40 hours a year. So the CPA is a fairly rigorous process to go from zero to hero, and you've got a number of steps along the way, which include practical training, formal education, and then testing to kind of pull all of it together. Once you've gotten to that CPA point, you've kind of hit that. It's almost like passing the bar for an attorney. You've kind of hit the minimum requirements in order to be able to practice accountancy and represent yourself as an advocate for your client to the public as it pertains to accountancy. So represent that their financial statements are fairly presented, represent that their tax position is accurate. So that's your certification for CPA. Now, everything I just talked about is important stuff and very useful if you're working in a company, but it's not what a controller does. And it's only a subset of what a controller does. Controller actually has a little bit broader scope. So normally when a company needs, when a founder says, hey, I need a CPA, really what they mean is I need a controller. Many CPAs move from public accountancy over into controllerships or CFO roles in private companies or public companies. The chief accounting officer in many offices is called the controller, and they're responsible for managing everything accounting related. Controllers stay on top of legal matters by staying on top of tax law. They stay on top of GAAP. So if there's changes in generally accepted accounting principles, they understand how to reflect those in the books, and they book those and make sure that they're compliant. They prepare the financial statements, or are responsible for oversight of the preparation of the financial statements on a monthly and quarterly basis. So a controller is kind of, in that big picture, the head accountant for the company. The controller is also in charge of financial planning and budgeting, unless the company has a separate financial planning and analysis person or department. And then sometimes as the company gets larger, you'll have a CFO, and the finance department or the accounting department or the CFO's area is split into two. You have an accounting group, which is responsible for accounting functions only, and that's run by the controller. And then you have a finance group, which does financial planning and analysis, and that's run by like a vice president of finance, for instance. But for the most part, in most small companies, you just have a controller, and a controller does financial planning and budgeting at a fairly general level. And the other piece is, at a small company, you normally have a couple folks. Accounting requires what we like to call dual control. So you never have one person responsible for everything without it getting checked by somebody else. That's an easy way for fraud to occur. And so in a smaller company, you may end up being the dual control, which I talked about in the last video, where it's kind of important for you to stay on top of reviewing the bank recs and signing the paychecks and signing the vendor checks and doing a fairly good review and knowing your numbers. If you have a controller, you can sometimes split that with a couple folks in the department. So the controller reviews everything, and then you may do another review, sit down with a controller on a monthly basis and do a monthly financial review with them. But you'll also have a review where you're kind of going through and the controller is reviewing the staff accountant or the bookkeeper's bank reconciliations and bookings and financial statements to make sure that they're accurate and correct. As the company grows and the volume of work increases, sometimes it's necessary to hire additional help as well. And so the controller is responsible for kind of setting the plan for what the accounting department should look like, making sure that the procedures are well documented and followed, and then making sure that if and when there's a need to hire, they go through the interview process, they hire qualified folks, and they follow those processes and procedures, and that's all been budgeted and factored into the financial statements and your financial forecast, so you don't kind of blow up your financial performance along the way. If the company has only one person in the accounting department, you, the owner, play a critical role in that dual control, as I had mentioned, and you need to provide a check on all the transactions, you need to review the work, and whether there's multiple folks in the accounting department or just the controller, you really need to be, at a minimum, having a monthly sit down with the controller and walking through the financial statements, even if it's half an hour, and taking a look at the budget, taking a look at the actuals, look at where there's differences between the two, questioning the variances, getting the backup documentation you need to understand why there's a variance. Don't just take the superficial answer as a correct one, especially if your gut doesn't feel right. Kind of dig in a little bit. But those monthly business reviews are critically important for you as the owner to both understand your numbers as well as to maintain accountability in the accountancy function. The controller is also responsible for preparing tax forms, and corporate taxes or partnership taxes, as you're probably aware, far more complex than your personal taxes are, and personal taxes are bad enough. So a lot of times, my recommendation has been, look, make sure the controller is really, really, really good at the financial piece, and that they book things right, that they've got a good feel for what the accountants are going to need to prepare the taxes, and then hire an outside firm to do your taxes, because the tax law changes regularly, and if you don't know what you're doing, it can cost you a lot of money, both in terms of penalties and interest if you don't report it right, or in terms of loss deductions if you don't know kind of how to take best advantage of the rules that are out there. And so I generally recommend it for most small business owners to go find a controller who knows the accounting process well, and have them focus on making sure your books and records are in really good shape, and then leave the taxes for a tax firm who specializes in that and knows what those tax laws are, and that knows what the changes are and how best to apply those to your situation. As I had mentioned, in larger organizations, the controller has the accounting function. You may have a CFO above them, and my recommendation has tended to be, if you've got a good, strong controller, they may never become a good, solid CFO. CFO is far more of an executive manager, outward facing, being able to deal with external stakeholders, manage your audit, manage your investors, manage your board, be able to sell your company to others, essentially, as well as be able to have a good feel for the finance side of the business, the budgeting, the forecasting, the capital budgeting, so knowing what the balance sheet should look like. The controller tends to be rearward facing, what happened and how do I report it. Finance tends to be forward facing, based on where we're at today, what do we expect to happen. It's difficult to be really good at both, and so I've tended to say, look, really good controllers sometimes don't make really good CFOs, because CFOs have to be more forward facing and planning, and as a controller we're trained to kind of look backwards and assemble data accurately. So don't assume that the controller you have today as your business grows will turn into your CFO tomorrow. And a lot of the mistakes that I've seen made in scaling companies is trying to make that controller something they're not going to be. A great controller is worth their weight in gold and will save you a lot of time, money, energy, and effort by having really good accountancy function. But that doesn't necessarily mean that they're going to be right as the company scales to be your CFO. And when it comes time, we'll have a separate video on what to look for in a CFO, but what to look for in a controller when you're hiring them is somebody who knows your accounting and accounting systems, ideally has experience in your industry. Certainly, if they've got a CPA designation, that's a plus, but it's not necessary. You want somebody who really wants to be able to be very accurate, wants to understand and follow the generally accepted accounting principles for your industry, and has a good attention to detail, ability to communicate, a fairly decent level of experience with the preparation of financial statements, is intellectually curious, and is impeccably honest. If you can find somebody like that who's willing to work hard and recognizes that, for 2 weeks out of the month they're incredibly busy, for 2 weeks out of the month it tends to slow down a little bit, and they can deal with some of that fluctuation, and their days are always going to be a little bit different, but their months are generally going to be the same. That's who you're looking for a controller. Again, doesn't need to be a CPA. CPAs are, some of those skills are useful as a controller, but they are, as you've kind of heard, a little bit different skill set. The other piece, and I should have mentioned this earlier, that a controller does is usually manage, a series of not only processes but people. And sometimes CPAs are individual experts, and so they kind of sit down, work through their stuff on their own. A controller, particularly in a growing company, is someone who needs to have managerial skills. CPA, you could be an excellent CPA and not be able to manage your way out of a paper bag, but you can't be an excellent controller and have that same, lack of management skills. So those are some things to look for. That's a difference between a CPA and a controller. Most businesses need a controller. They don't necessarily need a CPA in-house, but they likely do need a CPA, particularly one that's good in tax, outside, in order to be able to put that finance team together to maximize your profitability in your drive to FI. Until next time.